Welcome to BD Daily Finance News Podcast, daily insights on markets, economy, and investing. Today is 2025 December 12th, and we've got three big threads. The Fed cut and what it really signals, the AI trade doing the financial equivalent of tripping over its own shoelaces, and silver sprinting so hard it's making portfolios sweat.
I love days like this. The Fed whispers one sentence, tech stocks faint, and silver shows up like, I'm the captain now. If you're listening while checking your 401k, breathe. We're going to translate the chaos into normal person decisions.
Story 1. We're reacting to coverage of a Federal Reserve rate cut and the forward guidance around it. The cut is the headline, but guidance is the real plot, because it shapes what investors think happens next to borrowing costs, mortgages, and business investment.
Forward guidance is basically the Fed's soft launch of your future stress. Like when your boss says, no big changes coming, while holding a spreadsheet called Layoffs Q1.
Simple version, the rate cut is the Fed lowering the price of money. But if the Fed also implies we might pause, markets can react in mixed ways. Stocks may like cheaper money, while bonds reprice depending on whether inflation and growth risks are rising or falling.
So it's like your gym lowering membership fees, but also hinting they're about to remove half the treadmills. Cheap is nice, but you still might not get what you came for.
Why it matters, if cuts continue, variable rate debt gets relief faster and refinancing can come back. If cuts don't continue, the financial conditions easing story can stall, meaning risk assets can stop levitating and households may not feel much immediate benefit.
Actionable take. Don't chase a rally just because you heard rate cut. Check your own rates. If you've got high interest debt, the best trade might still be paying it down because your credit card does not care about your macro thesis.
Story 2. An AI-led tech slide extending into a third day, with names like Oracle and Nvidia under pressure in pre-market trading, tied to AI bubble fears and mixed results. This is the market asking, are we paying for real earnings or just vibes?
The AI trade right now feels like ordering a fancy tasting menu, and then the bill arrives with a note, chef's concept, infinite valuation. Suddenly everyone's like, wait, how much was the foam?
Finance behind it. When expectations are extreme, good isn't good enough. If a company reports mixed results or cautious commentary, the market compresses the multiple, meaning the price investors are willing to pay per dollar of earnings drops fast.
So the stock isn't always reacting to what happened. It's reacting to what it was promised in everyone's imagination. The imagination has been doing a lot of heavy lifting this year.
Why it matters for normal investors. If you're concentrated in mega-cap tech, you can have a diversified index fund on paper, but still be heavily exposed to one narrative, AI capex, data centers, and chip demand. When that narrative wobbles, correlations spike.
Practical move. If you've been ignoring rebalancing because tech only goes up, congratulations, you've discovered the emotional support strategy. Consider trimming back to your target allocation. Boring, yes, but boring is how you keep money.
Story 3. Silver's rally. One report notes silver crossing Microsoft's market cap to become the fifth largest asset globally, with a cited market cap around $3.593 trillion after a huge year-to-date rise, helped by expectations for Fed cuts that boost non-yielding assets.
Silver really said, I'm not just for your aunt's jewelry box. Passing Microsoft is unhinged behavior. But also, when rates fall, suddenly shiny rocks look like financial philosophers.
Simple finance. Silver doesn't pay interest. So when yields are expected to drop, the opportunity cost of holding silver falls. Add momentum and positioning, and you can get a powerful squeeze higher, until it isn't.
Silver can be a rocket and a trapdoor. If you're thinking, I'll just buy some because it's trending, at least decide your rule before you click, like a small allocation and a plan if it drops fast.
Quick recap. The Fed cut matters less than the path implied by guidance. AI stocks are fragile when expectations outrun earnings, and silver surge is a reminder that rate expectations can reprice everything. Your checklist: watch bond yields, listen for earnings language about AI spending, and keep allocations intentional.
And please, for the love of compound interest, don't build a portfolio that's just AI, silver, and vibes. Subscribe for the next episode and send us to the friend who thinks Forward Guidance is a meditation app.